education and advice are two different things, right? Education should be like, these are what the rules are. These are pros and cons. This is what could or could not happen. Advice is, no, this is what you should do.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Hello, Jake. Thank you for having me. How are you doing?
Doing pretty good. We are recording this prior to my trip to Rhode Island and Boston. You ever been to Boston? You've been to Boston?
Yes.
You've been to Cheers? Have you gone to Cheers?
We went, 2 years ago. How much time are you spending in Boston?
Just a day or two.
Okay.
Then we're going to rent a car and we're going to go to Rhode Island, Newport, Rhode Island, which is on the water there. Of course, I am playing golf, Cory. Taking my wife, though. Taking my wife. We're doing a vacation.
Good.
We like to do it this way where I play golf 1 or 2 days and then we hang out and explore, relax. This is going to be a relaxing trip for us, hopefully. So we try not to do too much. Again, golf is not too much for me. So play a couple times, check out Newport, play some golf, eat some good food, seafood, and relax.
Get yourself a lobster roll.
I'm sure I'll have one of those or two. That's
good. And if you and Rachel, Jake, end up with any time to kill, probably not likely, but if you do in Boston, when we were there 2 years ago, we did it was called the Road to Revolution, and it was like a walking tour dating back to the Revolutionary War. Not your thing? Okay.
No, I got no time for it.
Oh, gotcha. Okay.
It is my thing.
2 hours. 2 hours.
I got no time for that, but it is my thing.
Next time.
We're flying in on a Sunday afternoon. I'm going to watch the Chiefs game, and then we're going to go to dinner. And then we're going to wake up Monday and drive to Newport.
Okay.
And then when we come back from Newport, I'm sure it'll be the evening. We'll go to dinner. And then we wake up and fly. You see what I'm saying? I ain't going to get the time.
Next time.
Next time. What about you? What's new with you?
There is not too much new with me. I am looking forward to actually watching the next Chiefs game. With last week's game being on a Thursday, it's felt a little out of sorts since the season started. But that's really it. Not too much else, just rocking and rolling here, but all is well.
Good. And before we dive into today's topics, first off, I want to thank our audience. Our subscriber count continues to grow, so thank you for that. Please like and share our content. Let's give us a 5-star review. If you're listening to this, a thumbs up. If you're watching this, the whole reason we're recording Upticks is to enhance financial literacy. The show is not advice. We're just trying to bring some awareness to financial planning and investments. And actually, Cory, I was meeting with someone today, and they brought up they're savvy, right? They've done a lot of homework on their own. They've listened to other advisors, and they brought up something called Monte Carlo analysis and how it pertains to sequence of return risk. So I want to talk about that because we don't buy into that, which is somewhat unusual. And so what a Monte Carlo analysis is typically 1,000, and in our industry, different market rate of return assumptions, right? So market goes up 30%, down 30%, and everywhere in between, right? So it's a lot of different market return assumptions, 1,000 of them. And what the argument is, you want to test this, you want to test your financial plan using this metric, because sequence of return risk means if you retire, Cory, and the market crashes, does your financial plan still work? Which is a very important question, frankly.
Valid question. Absolutely.
Very valid question. Now, I think I surprised the guy a little bit when I said I don't believe in Monte Carlo. He was like, that's interesting. And the reason I don't believe in Monte Carlo, one, life is too ambiguous to think that the Monte Carlo is going to provide any more certainty in a financial plan. It doesn't work that way. You got to review the plan every year. That's the only way to make sure your plan is updated. You got to keep reviewing it, right? Just like your health. You got to check in your health. You can't say I went to the dentist today, Cory. I don't need to go for 30 years. It's not going to probably work out well for you. Maybe it will. Maybe you're lucky, but most people it doesn't.
Not a risk I'll take.
Exactly. But the other reason I don't like it, Cory, and I'll let you chime in, and I know you and I agree on this, probably wouldn't be working together if we disagree. This is a pretty big deal.
Right.
Is that I don't look to sell stocks for a retiree when the market is down. And that's what Monte Carlo assumes you would do. And we do not aim to do that. So we are diversified. Diversification, stocks, bonds, options, cash, and a variety of different asset classes to hopefully, nothing's perfect. No, there's no guarantee here, but to hopefully not have to sell an asset that has depreciated. So that's why Monte Carlo is somewhat useless to our clients, because we don't look to forcibly have to sell something if that something is down in value. Now, we may sell it at a loss because maybe our thesis has changed, but we're not selling it because we're trying to generate cash flow necessarily. Did I explain that well?
I think so.
So the takeaway here is this is our opinion, very opinionated show here, Cory, but don't buy into Monte Carlo unless you're in some cookie cutter portfolio that, is just slapped together, and then you probably need to pay more attention to Monte Carlo. But again, that's not how we do it. We don't slap together some cookie cutter portfolio for our clients. We're looking to provide a diversified mix of stocks and bonds that we select for our clients, and we set up their cash flow needs according to their financial plan. It's very important. Good. Well, thank you, Cory. I want to bring that up. I thought it was a good subject. It's a great question, and hopefully, I opened up his eyes to just another way of thinking. Because again, I think too many advisors rely on Monte Carlo, and it's silly, in my opinion. It's pretty silly, pretty dangerous to rely on something like that.
Right. Yeah, it is. Yeah, there are some flaws with it, right? And it's okay. Doesn't mean that it's completely worthless, but recognizing what it is. Like if you're assigning that analysis in a percentage of probability of success and tying too much to that, that's where I think, being careful, because the dispersion of outcomes can be huge, right? Which I understand is why this exists in the first place. But if it is flawed in that we would not, for a client who just retired before a market crash, that we would not have their portfolio set up in a situation where we would have to sell stocks that we just bought in order to be able to fund their cash flow and financial plan. So
right.
I think, yeah, exactly.
Right. If anything, Monte Carlo does what I always say is a hashtag buy low, sell high. You know what I mean? It's like you don't want to have to sell low. That's really the takeaway from Monte Carlo. That's all it should be, in my opinion. That's all it should be used for, is saying, hey, Mr. and Mrs. Client, look what happens if you sell low, how it's going to damage your financial plan. That's what it should be used for. But other than that, it's just for frills. I think it's to me, and again, this is my opinion, I think advisors hide behind it and want to make themselves look fancy. That's why they do it. And to me, it's a little stupid. So
That's fair.
So anyways, all right. Wait, Cory.
Strong opinions, Jake. We're starting off strong here. I like it. Okay. First headline here: how to invest in stocks.
I really enjoyed this article, Cory. There's several key takeaways here that I want to talk about with you. Number one, in the article, says set your time frame. This goes along with what we're just talking about. And in our opinion, more opinion here, Cory, you should be buying stocks that you need to access anytime soon. You shouldn't be putting money into stocks if you need the money in the next 5 years, for example. Again, this show's not advice, but I like this article started with that, Cory. It said set your time frame. Stocks are volatile. There can be risk. So if you're going to invest capital, how long until you're going to need to access that capital? You need to set that time frame first. The second one is decide how much risk to take. So this should be your asset allocation. Are you 50-50, 60-40? And I'm talking about your stock to bond blend. So you want to see how long do I need to be in stocks, and how much of my money do I actually want in stocks to begin with? Next one, Cory, is decide your investing style. This would be individual stocks versus products like mutual funds or index funds. Also doing it on your own versus hiring an advisor like your friends at Falcon Wealth Advisors. So again, what is your style going to be? How are you going to get into the stock market? Number 4, Cory, plan for taxes. So if you're doing this in a taxable account, an IRA, a 401k, a Roth IRA, all those are handled differently according to the IRS. So you want to just do your homework and understand what are your tax implications if you make or lose money. You certainly can lose money. And I love this one, Cory. The last one is open your account. But you notice they didn't start with opening your account.
Mm-hmm.
That's where I think the huge problem is, Cory. I think people that want to get into stocks, they open their account first. They open the account before they think about anything.
Yeah, I think
Let's
that's
download Robinhood. Let's get the confetti going, and then we'll figure out what we want to buy. That's what people do, and it's wrong. It's wrong, wrong, wrong. If you're going to do this, it's dangerous. You're playing with fire, and it can be a wonderful thing. But let's set that time frame, determine your allocation, understand your risks. What is your approach going to be? Understand the tax implications. Then, and once you got all that figured out, then go ahead and open up your account. I thought that was cool. Bravo to the author of this article. I thought it was well done. You have any thoughts on this?
Yeah, it's really good. And I think you're exactly right that people probably do get that backwards. What I think is interesting about it, though, is aligned with what you just talked about, the Monte Carlo analysis and actually managing sequence of return risk. That's crucial with that first step in setting your time frame. And that's the reason that we take that approach. But yes, I think that this is a really good high-level overview of the right way to think about it, because otherwise, if you're just throwing darts at the dartboard, maybe it works, maybe it doesn't. But I don't think that that's why people invest their hard-earned capital.
Hopefully not.
Okay, hopefully not.
All right, good. Let's go to the next one. Cory, retirees, it's time to give yourself a raise. How to keep the cash flowing for decades. I saw this article, Cory, but I didn't read it. I think I saw this one. What do you got?
So this was about new research that indicates a 5% withdrawal rate is, quote, safe versus the old 4% rule. But how you invest your money and how you tap into the portfolio is critical to keep cash flowing. So we've talked about the old 4% rule. If someone retires, take 4% of their account, increases it for inflation. The argument for a myriad of different reasons here is that safe withdrawal rate is higher now. What I really found interesting and what jumped out at me, Jake, from this whole article was that it indicated that more than half of retirees, 53%, say that they wing it, withdrawing money whenever they need it, according to a recent survey by investment firm Schroders. And the comment that I made, Jake, was that I don't think that winging it is what our clients want to do, nor do I think that that's the recipe for a comfortable retirement. And ultimately, I think that exact numbers for withdrawal rates matter less than having a plan in place in the first place.
Yeah, I agree. That's crazy. Now, again, who knows who they polled or surveyed?
Of course.
But half the people in this survey said they wing it. That's scary. And that's why we have a real retirement problem in America. And
that's right.
I agree with you. I think 4%, 5%, I think that, again, the more important is to have a plan. Sometimes our clients pull out 8%. Sometimes they pull out 2%. It could be the same client, and it could change like that year to year. Like you said, I think the key is having a plan. I think it's important to know what your withdrawal rate is, but not to get fixated on it. So our planners will go over that with our clients in the review meetings. They will say, hey, Mr. Bittner, your current distributions are 6%, but your account is averaging 7%. So therefore, your financial plan looks like it's still healthy and in good shape. Or they'll say, Mr. Bittner, you're pulling 10%, and we're only making you 7%. And you're going to run out of money in X amount of years. And they'll go over that too. But we don't wing it here. I don't think anybody should wing it. And again, I don't think you should do 5%. I think you should do whatever makes sense for your plan. Good one. Good article.
Got to capture it properly in my Monte Carlo analysis, though, Jake.
No, Cory.
I'm just kidding.
Not
Okay.
Monte Carlo.
All right, Jake. A couple wants to save more for retirement, college, car, and a house. But how?
Yeah, I liked this article. It was a case study, basically, and it was very detailed. So it's a younger couple. They make good income. They've got 3 kids. They spelled out everything, how much money they have saved and what they're doing, their job, and blah, blah, blah. And a financial advisor chimed in and answered this case study with somewhat advice. It sounded like advice or their recommendations. Now, I appreciate the article bringing up a case study. I also think, though, Cory, that it left out a lot of questions that the advisor should have asked. For example, he recommended increasing their savings and their insurance, life insurance. But how would he know that without asking more specific questions, right? Like, when do you want to retire? How much do you want to spend? Or do you want to leave a legacy to your kids? And, the mom or the wife is stay at home right now. And I don't know why he was recommending she get life insurance or up it. So again, to me, it felt a little salesy without asking more questions. And so here's my takeaway, though, for our audience, is to not take advice online from anyone, not even me or you, Cory.
It's good.
Instead, meet with your wealth advisor or your financial planner one-on-one to have these conversations. And my point is there's far too much nuance that needs to be discussed than just throwing it out there online. Now, maybe this is a weird one. I don't know if these even exist. Maybe you have a virtual wealth advisor that does this online. But again, that still would be classified to me as a one-on-one conversation. But there needs to be a dialogue. There needs to be back and forth. There needs to be numbers crunched. So don't go to these chat rooms. You can participate in these chat rooms, but you understand that it should be for educational and entertainment purposes only, not for advice. It's different. Education and advice are two different things, right? Education should be like, these are what the rules are. These are pros and cons. This is what could or could not happen. Advice is, no, this is what you should do. That's very dangerous when you take advice online from anybody. And again, not that you and I are bad people. My point is, I'm not going to give some stranger that I don't know very well advice online. I wouldn't do that. That would be reckless for me to do as an advisor. Any advisor that is giving advice online, in my opinion, is being reckless. And so, again, pros and cons are fine, good and bad, potential risks, all that's education. But don't take advice online. That's my takeaway from that. Any thoughts on that one?
That's good. That reminds me, interestingly, Jake, we make this connection a lot, but for the same reason that a lot of times people actually know, or they choose not to Google something as it pertains to their health, right? Or WebMD or whatever it might be. Like there's, people recognize that if you go down that rabbit hole, you can end up in a crazy place. But it's interesting that people acknowledge that around health, but for finances, it's like people are looking for other perspective or advice like that. Like the same way that people avoid Googling things for their own health, they're actually looking for those things when it comes to their finances. And the bigger point is you need to have a one-on-one conversation with the professional to actually figure out what the right thing for you to do is. Otherwise, you're educating yourself and learning, like you said, Jake, which is not a bad thing. But don't confuse something that is painted with a broad brush or something that's just education as specific advice for what you should do.
Right. And remember, you get what you pay for. If you're getting free advice on TikTok, how good is that?
Right. And if the advice doesn't work, then what?
Right. If I want real advice for something, I don't care what it is, I'm happy to pay for it. We got our new house, we had a ton of furniture, tchotchkes, drapes.
All kinds
of stuff. We paid for that advice. And it looks good. We weren't going to get that for free. It wasn't going to come out that good for free. And that's a smaller example because we're talking about drapes. This is your financial plan. It's even more the reason that you should pay somebody, a fiduciary, a wealth advisor, someone with a track record, a background, licensed. That's who you should be getting advice from, that knows you, one-on-one situation. Good. All right, Cory, looks like you're bringing a chart back. Is that what's going on here?
That deep into the vault? Yes.
Here we go. Cory, okay. Stratega's macro policy outlook.
Yes, I wanted to share this, Jake, because there's been so much discussion about it lately. And my comment, so first off, this chart here is just talking about the Senate races in a lot of different states, and ultimately is talking about the potential tax agenda for the next president. Because there's been a lot of conversation about tax increases, taxing unrealized capital gains. We've gotten a lot of questions about that. And there are high-profile economists, Jake, that have endorsed the proposal to tax unrealized gains. And I want to be clear here that no one in Washington, D.C. has asked my opinion, but I would like to make my stance clear that I think that taxing unrealized gains is a terrible idea. But fortunately, a split Congress will limit the size and level of any new tax agenda as they've highlighted here, and that's what this chart is talking about, is that ultimately this is a lot of water cooler talk because of the likelihood around Republicans taking control of the Senate. We talk about gridlock on the show and political outcomes and the influence on the market, or sometimes the lack thereof. The bigger point here is something like taxing unrealized capital gains is a meaningful change, and it is something that would require congressional approval. And it's also something that sure, it's being discussed as a policy, but it's not something to be up in arms about. Because we have to bring it back to what's really going to happen. And on one hand, we don't know, but on the other, like we do need to work with the actual likelihood here and not make any drastic or crazy changes based upon something that's been proposed. What do you think about this, Jake?
Yeah, and regardless of your political affiliation,
Yes.
I don't know why someone would be okay with taxing something that's been unrealized. I mean, it's so stupid to me. And maybe they're only going to do it on the top 1% of 1%ers. That's still wrong, because the way I see it, Cory, is, yeah, there's some really ultra wealthy people. And yeah, they probably can do a lot of advanced planning to perhaps not pay as much on a percentage basis as me or you or the average person, right? However, that doesn't mean that we need to change the rules and make them ridiculous because of that.
Right.
Because in my opinion, then you are squashing the American spirit. And the American spirit is about working hard and becoming successful and capitalism. And if you want to make more money, you can make more money. And if the rules fall in your favor, they fall in your favor. But I don't think you need to go make these extreme rules for people that have been extremely successful. And by the way, these people typically pay a lot of taxes anyways. So I think it's silly. And you're right. I'm glad you shared this chart. I don't like charts, but my point, I've been telling clients, that's all nonsense. And it would be extremely unpopular. And you got to remember, Congress doesn't want to upset the ultra high net worth people either, because those are the people that donate to their campaigns.
That's right.
So why would they want to make them mad too? So again, I'm glad you shared it. I don't think people should be overly concerned about it. And it's more of the reason to hire a wealth advisor, to meet with your financial planner, go over your tax planning, go over your financial plan. And then as and if the rules change, we'll roll with it and we'll adjust accordingly. That's good.
Absolutely.
All right, Cory, I think we have time for one more here.
Okay.
Go one more.
All right, Jake. What should you do with your 401k when you retire?
Yeah. So another good one on kind of some pros and cons here. So again, this is not advice, but one of the options, I guess, is to roll over your money to an IRA. What the article said is that you'll likely have more investment options, not always, but you'll likely. Mm-hmm. You can streamline your accounts. The way I take this is maybe you're able to roll over multiple 401ks all into one IRA. You typically can have more flexible payouts. Sometimes 401ks are more structured on getting your money. So that's some of the features, I guess. You could leave your money in the 401k, sticking it with your 401k, or keep it. Not always, sometimes your cost and investment fees could be lower. The plan administrator must be a fiduciary. I thought that was interesting, Cory. If you hire a broker, you could roll your money to an IRA, and if you hire a broker, not a fiduciary, you lose some of that protection, and you could start paying commissions, right, for things. You might be able to tap the money sooner. So if you're age 55 or older, the year you leave your company, those are more flexible rules than the typical 59 and a half for an IRA. And the last one here, it said you might not be overwhelmed with options. Like if you're used to a menu of 10 or 20 things to pick from, that'll be the same way. That's probably for a do-it-yourself or more. But the point is, it's not a no-brainer to roll over your 401k. You got to understand the pros and cons. In fact, this is another good point here. Falcon Wealth Advisors, if a client wants to keep their money in their 401k, but still work with us, they can do that. They can hire us. We can manage the money while it's in the 401k. We charge, of course, for that, but they don't have to roll over their money to us either. We only do it if the client wants to do it, right? And they've got a real reason why. Right. Or if those other things apply. Maybe we have more investment options. Maybe the costs are lower. Maybe the client's looking to consolidate, right? So we want to weigh those things before we recommend it. Maybe the client's 65 and that rule of 55 doesn't matter to them. So there's really no benefit. A lot of times people want to separate from their employer, Cory. They want to separate. And so that's another reason that we'll do it, because they just want to be done with it. So again, there's a lot of pros and cons to both. We are indifferent because, again, we can manage the money the same way. We don't have an incentive. If you want to hire us to help you manage your money, it can be in your 401k or in an account with our custodian, and we'll charge you the same. It's the same cost to our clients. So anyways, I thought that was a good article. It was a good one. What do you got?
I just wanted to just share a quick story that's aligned with this, though, Jake, because I think it's aligned with a lot of what we talked about here today. A big theme being, let's not take advice from strangers online. And also the point that you made here about it's an important decision what you do with your 401k when you retire, and there shouldn't be just an automatic default answer. I have a client, Jake, a new client that we are working with, who has a benefit available through a retirement plan because he's actually a clergy person. He has the ability to take a certain dollar amount out of his retirement account in retirement for a housing allowance that he doesn't have to pay federal tax benefits on.
Interesting.
But if he rolls the money out of the account into an IRA, he loses that flexibility, and which is pretty meaningful in this situation. So that's a perfect example, though, of the nuance and the context that's required for individual financial planning, as opposed to here's what somebody online says. So I just wanted to bring that up as just a quick example, but this literally was this week, Jake. We just had a conversation about this. And that's why I want to bring that up, because that is what we really want to get deep into with our clients. So we're giving them the right advice when we are in that one-on-one setting and when it's appropriate.
Yeah, excellent. That's perfect. That's very good. It makes a lot of sense. And you're right. So if you've got questions on your 401k and rolling it over or keeping it in your plan, let's schedule an appointment with your friends at Falcon Wealth Advisors. Let Luke know, Luke@falconwealthadvisors.com. Also, if you get any topics that you'd like Cory and I to discuss live here on Upticks, please email Luke@falconwealthadvisors.com, and Luke will make sure we talk about your topic on our show. Thank you again, Cory, for joining me, and thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.